ready to rumble? What's up, guys? It's your boy, Mr. Fit to Flourish, and welcome to the Fit to Flourish podcast. Today, we're going to continue our talk on key levels and moving averages. Now, the very next key level or idea that I wanted to talk about is the ease of movement strategy. Now, this concept is one that doesn't necessarily have a name, but it is a theory that basically states that the easier it is for price movement to go up, the easier it will be for it to go down. So if it is harder for price movement to go up, it will be harder for it to go down. And this is because for each level the price stopped at on the way going up in the past, it will need to test or stop on the way going down. So these tests can take anywhere from a few hours to sometimes weeks. So here are a few examples of the ease of movement strategy and how stocks can have a lot of trouble moving up when there's areas of consolidation or where it's moving sideways. And then as you can see here, price is just dramatically moving up. And then as soon as it got to the top, it dramatically fell down. And it happened pretty quickly. To continue the lesson on prices, trends, trend lines, key levels, we're going to move on to trend lines. So there's two different types of lines. There's trend lines and there's channel lines. Trend lines are drawn between two extremes on the same side. Channel lines are drawn on the opposite side of the trend line and form a channel. So we talked about two different trends. We talked about uptrends and we talked about downtrends. So in an uptrend, the trend line is drawn from two extremes, two low extremes on the same side, and the channel line is drawn on the top of that uptrend. So as you can see here, the trend line is drawn by meeting two lows, two extremes on the low side. And then on a downtrend line, the trend line is drawn from two high extremes going down from left to right on the chart. And the channel line is drawn on the opposite side. Now, what is a channel? So a channel or a trend channel has to include both the highs and the lows of a trading range. So if you have an uptrend, you have your trend line including two extreme lows and then the channel line and two extreme highs. So the channel contains the highs and the lows of that range. Something to note here is that the tighter a channel, then the more likely it is for price to continue in that direction. Channels are important because once you fall out of a channel, you can pretty much guarantee a break where price will start to deviate from that channel. So if you're in an uptrend and you break down, then you're probably going to continue down. And if you're in a downtrend and you break up, then you're probably going to have a continuation move up. And these are just general guidelines. Let's talk a little bit about consolidation. So consolidation is trading sideways within a price range. And that's going to be trading between two parallel lines. A correction is a fall of 10% or more from a recent high. And a pullback is when a stock pauses or has a moderate change up or down in price from a recent peak. Also, one thing to note, don't be afraid of pullbacks because they're normal and they are some of the best times to get into a trade. Continuing along the lines of price movement, price direction, key levels, and trends, we need to understand the difference between a trend bar and a non-trend bar. So this is something that a lot of traders do not talk about on the internet or anywhere on social media. So a trend bar is a bar that is pretty big, it's pretty large, and it contributes to the direction of the trend. So a big green bar would contribute to the upward movement of price and the upward movement of an uptrend. A big red bar would contribute to the downward movement of a downtrend. Now, a non-trend bar is a bar that just kind of causes consolidation. So it's just very small bars or dojis where when you see them form, they don't really help price go up or down. They just kind of cause price action to go sideways. Trend bars cause big movements in prices and contribute to an upward or downward direction in the overall trend. So that was another really good lesson on price movement and how prices move. We talked about auction market theory, we talked about key levels, and now we talked about moving averages, trends, and trend lines. Now we're going to get more into how moving averages can affect the way you trade and strategies you can use with these moving averages. So stay tuned. It's your boy, Mr. Fit to Flourish. Thanks for tuning in. I'm out.
Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.